Welcome to the Daily Block, the top events happening in the past day in crypto and why they matter. Fast traders, degens, and those who refresh CoinGecko at 3 a.m., buckle up. Crypto ETFs smash records, nearly $5.95 billion in inflows. CoinShares just logged a record week with roughly $5.95 billion pouring into crypto ETFs, dominated by US spot Bitcoin products, which drew about $5 billion. Europe also printed national inflow records. In one Bitcoin ETF session, saw trading volumes near $7.5 billion. Ether spot and staking ETFs are exploding too. Grayscale staked 32,000 ETH on day one, and daily ETH ETF volumes are massive. Why it matters for crypto investing. These concentrated ETF flows are the short-term macro pulse now. Liquidity and headline-driven moves beat on-chain narratives for intraday traders. Risk counterpoint. ETF flows can flip from river to trickle in a heartbeat. When flows reverse, liquidity dries and volatility spikes. Next up, Bitwise says Q4 2025 could out-inflow all of 2024. Bitwise projects a monster fourth quarter as approvals, price momentum, and the debasement narrative collide. They expect institutional allocation to really ramp, possibly exceeding all of last year's ETF inflows. Their thesis leans on more asset manager approvals and macro cues like dollar weakness and looser money supply. If institutions show up in force, the next wave of capital could be structural, not meme-driven. Why it matters for crypto investing. Positioning for a pure institutional wave is one of the clearest edges. Liquidity futures basis and options skews will be shaped by big-ticket allocation flows. Risk counterpoint. Forecasts are just maps, not weather. Regulatory hiccups or a macro shock could delay or shrink that institutional bucket. Bitcoin technicals. Bulls defending around $123,000. BlackRock reportedly bought $899 million in BTC. Bitcoin pulled back into the $122,000 to $123,000 zone. Analysts pegged support at about $123,300 after short-term overbought signals cooled. Bulls are still making higher lows, and the next upside target looks like $135,000 if support holds. Adding fuel, reports suggest BlackRock bought roughly $899 million worth of Bitcoin in one day, and futures open interest is spiking as traders pile into longs. Why it matters for crypto investing. Support holding plus large institutional buys create favorable continuation setups for momentum traders. Follow the liquidity and options futures positioning. Risk counterpoint. Crowded longs plus overbought momentum are a volatility recipe. A sharp sell-off could liquidate leveraged bets hard and flip the narrative quickly. Stablecoins could drain up to $1.22 trillion from emerging market banks, says Standard Chartered. Standard Chartered warns that U.S. dollar-backed stablecoins might siphon roughly $1.22 trillion of deposits from emerging market banks by 2028 as users dollarize via digital rails. The bank highlights potential structural impacts on local liquidity, currency markets, and financial stability, especially if U.S. policy leans crypto-friendly. This isn't just a crypto thing, it's a potential capital flight mechanism. Why it matters for crypto investing. Stablecoins shifting real-world dollar demand can amplify FX moves and dollar-centric narratives, which can flow into Bitcoin as a pseudo-dollar hedge or trigger regulatory backlash that moves markets. Risk counterpoint. Local regulators and capital controls could blunt the pace of stablecoin adoption, and technological frictions still matter for mass dollarization. Whale rotates. 3,000 BTC sold for $363,870,000 USDC. A long-term holder just converted 3,000 BTC into USDC, netting about $363,870,000 US dollars, roughly $121,290 per coin. This whale has a pattern. Rotate into and out of BTC, ETH, and stablecoins depending on market cycles. That stash of USDC is dry powder that can redeploy fast or sit as a liquidity cushion. Why it matters for crypto investing. Visible whale conversions into USDC are both potential selling pressure and latent buying power. They can provide liquidity for exits or fuel rapid re-entry into risk assets. Risk or counterpoint. On-chain moves don't guarantee market intent. The whale might be hedging, moving OT, or preparing for non-market uses of USDC. BitDigital snaps up 31,057 ETH with convertible note proceeds. BitDigital used proceeds from a $150 million convertible offering to buy about 31,057 ETH, bringing corporate holdings to roughly 150,244 ETH. The raise came at a premium to the company's mark-to-market NAV, so this looks like strategic accumulation rather than desperate buying. Corporate balance sheet accumulation of ETH keeps shrinking available supply on the margin. Why it matters for crypto investing. Continued institutional and corporate accumulation tightens free float and supports ETH's price tail, especially when combined with staking narratives and demand for liquid staking derivatives. Risk counterpoint. Corporates can be forced sellers under margin or financing stress, and convertible note dynamics may introduce future dilution or sell pressure depending on terms. DeFi delists Aster perp volumes amid suspected wash trading. Token tumbles. DeFi removed Aster's perpetual volume from its aggregates after spotting suspicious mirrored trades with Binance and a lack of order-level transparency. And the Aster token slid from about $2 to $1.80. The delisting exposed how much of that liquidity might have been paper volume. Momentum traders who chased that narrative got whiplashed as the data source cut the rug. Why it matters for crypto investing. Integrity of volume matters. Fake or inflated volume can create false momentum and misprice funding and TVL narratives. When data providers delist or downgrade, momentum evaporates and rapid collapses happen. Risk counterpoint. Not all delistings mean fraud. Sometimes metrics change or new data reveals conservative views. Still, assume illiquid alt perp markets are booby-trapped. Forward Industries launches institutional Solana validator. Stakes about 6.8 million CAE with a 0% commission launch. Publicly traded forward staked roughly 6.8 million SOL, catapulting them into the Solana top 10 validators while offering institutional tooling and an initial 0% commission. That's a big treasury stake concentrated in one operator, and it reshuffles delegation dynamics on Solana. 0% commission is a grab for market share that can alter delegation flows quickly. Why it matters for crypto investing. Large treasury staking moves affect staking yields, validator competition, and delegated supply, all of which feed into sell-side behavior, liquid staking demand, and SOL price mechanics. Risk counterpoint. Concentration in validators raises decentralization concerns, and changes in commission or unstaking flow could reverse any short-term staking tailwinds. That's a wrap. Hit subscribe if you want this served daily. Short, snarky, and stuffed with the flows that actually move markets. That's today in crypto, where the gains are imaginary and the pain is real.